Hello learners, welcome again to our session today. Remember, it is a continuation of what we started earlier on, and we are doing our revision as we had stated earlier on. So in our class today, I want us to continue with the question number 5. Remember, question number 5 we did part A, and the concept that was being tested in that part A was about taxation of insurance companies. In our session today, I want us to handle part B of the question. I want us to handle part B of the question. And part B of the question, that is question number 5, of course, in our block model paper. Remember the bonded paper as I had mentioned, you can download it just above this video if you're using our phone application. And if you're using the web application, kindly, you can download it just below this video. So question number 5B, the concept that I want us to talk about in question number 5B is about shortfall distribution. Shortfall distribution. Shortfall distribution. It's about shortfall distribution. That's the concept that Mwalimu will want to handle in our session today, part B, that is shortfall distribution. So many a times, anytime we are talking about shortfall distribution, or rather shortfall tax, the concept that should click at the back of our mind, basically, shortfall is just that difference between what the commissioner is expecting us to distribute as dividends, because the whole idea is all about dividends. What the commissioner is expecting us to distribute as dividends and what we are actually distributing as dividends. That case, the difference will give us what? The shortfall. Now, the component of tax that is going to be charged on that shortfall is what we are terming it as what? As a shortfall tax. So, in other words, Mwalimu is saying that for any time you talk about shortfall, first of all, you should understand that I'm looking at a dividends perspective. A dividends are part of it, where we are saying for us to determine this shortfall in this context, we are talking about the prescribed dividends as per the commissioner, the prescribed dividends to be paid as per the commissioner, of course, Commission of Domestic Tax, and the actual dividends distributed. Actual dividends distributed and the actual dividends distributed. So the difference will give us what is known as a shortfall. Now, shortfall tax basically, shortfall tax now will be the tax on this shortfall. Tax on the shortfall. Tax on the shortfall. And at this point, you'll find that the component part of it, the tax component of it, is at the rate of 5%. At the rate of 5%. 5% is a component of tax that is going to be charged on the shortfall. A good question would be, do you recall how we are supposed to determine the prescribed dividends? To determine the prescribed dividends, basically, prescribed dividends, number one, we are going to talk about prescribed dividends as per the commissioner. We should take 40% of operating income, 40% of operating income, or a profit. This is after tax. Then we are supposed to take 100% of all other incomes, of all 100% of all other incomes, term it as investment income, of all other investment income after tax. After tax. So summation, or rather if we are to talk of this case, this is what now will give us what? Whatever that the commissioner is expecting us to pay or to distribute as dividends. So whenever we having this difference is what will give us our shortfall. And from the shortfall is going to attract a component of tax of 5%, which you're terming it now as shortfall tax, shortfall tax. And to do this, recall we had used a schedule which really assisted us to work it out. So in our question, I'll want us to go straight to our question and use a schedule that we had looked at to solve this scenario, rather to solve this problem. I'm going to share the question with us here so that we work it out. This is our question. Model paper, question number 5, part B. I've shared the question there. Mwalimu will share the question there. In that case, you are told that Samia Limited reported the following income during the year ended at 1st December 2020. Operating income, that is before tax, I'm given 12 million. Investment income, I'm given 650,000. Rental income, and this time I was given gross, I was given a figure of 1.6. Additional information, we are told that investment income comprised of the following. The figure that I was given, 650 there, it comprised of dividends from company in which Samia Limited holds 20% of the share capital, 100,000. Interest from fixed deposit account, net. Interest from fixed deposit account, net, 500,000. I'm given net, recall. Interest from treasury bills, net, I'm given 50,000. So the total, I'm given 650. Then you are told that Samia Limited declared a dividend of 1.3 for the year ended at 1st December 2020. Required, determine the shortfall tax, if any, payable by Samia Limited for the year ended at 1st December 2020. So you're given such a case, my good students. Where are you going to start from? Kindly take a screenshot of that question for those who are doing it. Now, whenever I'm having such a question, the first thing that we must always do is to do what? Is to smile, as always, right? Because we have the format, right? So our duty will just be copy-pasting the figures into our format. So let me kind of squeeze the question. We have it somewhere there for reference. Believe that is okay. So what we must do is to prepare our shortfall distribution schedule. So you're going to prepare our shortfall. This is Samia Limited shortfall distribution schedule, shortfall distribution schedule, shortfall distribution schedule, shortfall distribution schedule. Of course, this is for the year ended at 1st December 2020. For the year ended 31st December 2020. For the year ended at 1st December 2020. Okay. So the moment we do have this case, now we need to have our details right, identify our incomes. The incomes that I was given, we do have operating income. So yeah, we are having operating income. Number 2, we have investment income, but investment income we had category, that is dividends from, that is of course dividends from a company. This is dividends from a subsidiary company. We have interest from fixed deposit account. Interest from fixed deposit account. We are having the other bit here, that is of course interest from TB. Interest from TB. And the last one, we are given here rental income. We had our rental income. Rental income. So these were the incomes that we need to identify. Profit before tax. Profit before tax. Like for operating income, how much was I given for operating income? So rental income. I'm squeezing it at that point. Yeah. Profit before tax. For operating income, I was given a figure of 12 million. Dividends from subsidiary, I was given, and I'm controlling more than 100%. I'm controlling more than 20%, which in this case I was given 100,000. Interest from fixed deposit account, I was given 500,000. Interest from treasury bills, I was given 50,000. And the rental income, I was given a figure of how much? 1.6. So basically, these were the incomes that I was given. These are the incomes that you are given in that context. Talk about component of tax. Corporation tax, you are told it was at the rate of, this is 2020. So corporation tax, we know very well that in 2020, but of course you'll be given. But if we are dealing with 2020, we are going to use 25%. We are going to use 25%. So I'm going to take corporation tax being 25% because you're looking at it in 2020. Any data for 2020, basically you'll be using the rate of 25%. So we start by working it out, the component of tax. That should give us 0.25 by 12 million. That should give me 3 million. Component of tax. Dividends from subsidiary. Always recall that anytime you are dealing with dividends from a company, I'm receiving a dividends from a company which you control more than 12.5%. That one is going to be taken as an exempt dividends and therefore not taxable. We are controlling more than 12.5%. So therefore, in that case, is not taxable. Interest from fixed deposit account. Interest from fixed deposit account, if you can recall, these are non-qualifying interest, meaning that withholding tax is at the rate of 15%, but it is not a final tax. And if it is not a final tax, it is going to be subjected for further taxation. And again, what we should realize, if you can look at that question, we are told that the interest that I was given, the 500,000, this was net. This was net interest. So, because withholding tax is at the rate of 15%, so the 500,000 that I'm given there, that is the same as what? 85%. So what about 100%? Because we need to convert it to gross. We need to convert it to gross. So what about 100%? And this is what we are going to do. We are going to take the 500,000 times 100. We divide by 85. That should give me a figure of 588,235. So therefore, here we should be talking of 588,235. 235. What about the interest from TB? Interest from TB, and it is the company which is receiving. If it is a company which is receiving, these are non-qualifying interest subject to withholding tax at the rate of 15%, which is not a final tax. So the same concept will apply. That one is 85%. What about 100? So you should be talking of 550,000 times 100. We divide by 85. That should give us, of course, 58,824. 824. So 58,000 here. 824. 824. So basically that is our interests. So therefore, at this point, we should be talking of interest from fixed deposit account. We are talking of 0.3 by 588,235 to give us a figure of 176,470.5. That is the component of tax B. So determining the component of tax here, therefore we should be having 588,235 times 0.25. That should give us a figure of 147,058.75. The other case, of course, that is almost the same. 0.25, that should give us a 14,706. Kindly confirm. Then on 1.6, that should give us 1.6 times 0.25 to give us 400,000. Then recall what we mentioned, that at this point, therefore, determining these are our component of tax, right? So, profit after tax, we should be talking of course, we are determining that to be that. So, we're talking of 588,235 minus 147,058.75 to give us 441,176.58,824 minus 14,706, 44,118. Then the last one, that should give us 1.2, right? Come and talk of, remember, we mentioned that according to the commissioner, we are supposed to distribute 40%. It means that we can retain 60%. So talk about the retention value or retention amount here. Retention, 60%. If we are retaining 60%, what is 60% of 9 million? 5.4. Meaning that whatever that is going to remain to be distributed, that should give us 3.6, right? This one is 100,000. This one is 441,176. This one is 44,118. This one is 1.2. So if we add the other amounts, so we should be talking of 3.6 plus 100,000, 441,176, 44,118, 1.2. Of course, we should be having a figure of the prescribed dividends to be distributed according to the commissioner will be prescribed dividends distribution, prescribed dividends distribution according to the commissioner. Therefore, we should be talking of the summation of all that to give me 53,85,294 if you add all the three. Actual dividends distributed, actual dividends distributed. We distributed dividends, actual dividends distributed. We are given 1.3. So therefore, our shortfall, we should be talking of minus 1.3 to give me a figure of 4,085,294. Then what about our shortfall tax? So therefore, our shortfall tax will be shortfall tax. We should be talking of the 5% times 40,85,294 times 0.05 to give me a figure of 204,265. So basically, that is what you are supposed to do. That is what you are supposed to do. That is what you are supposed to do to determine our shortfall tax. So that will mark the end of this question. And thank you so much. Thank you so much. Let us meet in the next session.